Ever thought that a mere 1% in extra investment growth won't really make that much of a difference? But what if I showed you that if given enough time, every extra percentage point could mathematically double your net worth? But first, as a quick review, remember that US stocks have averaged about 10% per year going back several decades, meaning that any one-time investment would double over and over every 7.2 years on average. So $1,000 could grow into $1 million even if you totally forgot about it for 72 years. And if you missed that video, check out the link in the description. Okay, and so now that you know why time in the market is the first key to wealth creation, how about a quick quiz? Ready? What do you think the total return would be over that time if the average return were 1% lower at 9% instead? Pick between 900, 800, 600, or 500,000. I mean, how bad can it be, really? It's just 1% less. So, yeah, that 9% will get you to just 500,000 rather than $1 million. In other words, losing just 1% of investment return annually would shed about half of your future growth over 72 years. How in the world is this possible? Well, it's because the compounding growth curve is a curve and not a straight line. So the longer your time horizon, the greater the distance between each percentage point as you climb the ladder of time. But even if we're to shorten the time period to 30 years, the loss of each percentage point in growth can knock off as much as a full quarter off your future wealth. Staggering, isn't it? So, please do not forever and ever think that the difference between 8, 9 or 10% growth is all kind of about the same, okay? Because it might as well be the distance between entirely different planets. And that was the only time I'll ever mention outer space, planets, or astronomy. But how about those savings accounts? What if you parked that $1,000 there at 5% interest for the next 72 years? I won't even ask you to guess this time. I just know you'll get it wrong. Because it would grow to just 35,000. Yeah, that's nowhere near $1 million at 10% growth. I mean, you can barely even see the curve at 5%. Practically a bank robbery. So never be fooled into thinking that simply because the rate of return is half as much, that your total wealth will also be half as much. What's even worse is that savings accounts have rarely paid an interest of more than 2%, let alone 5%. And money sitting in a checking account may barely pay any interest at all. And this, my human, is why even long-term savers cannot build meaningful wealth, and why investors can. And understanding this early in life is the second key to wealth creation, plain and simple. So do spend some time playing around with the growth calculator that I've linked in the description. And you can see the difference that each percentage point can bring over your time horizon. All right? But before you start chasing the highest returns possible, there's a crucial trade-off between the rate of return that you're after and the risk that comes with that. So think of risk and growth as the opposite sides to the same coin. The yin and the yang, maybe? Okay, you just can't have one without the other, all right? So lower growth rates, such as money in your bank, mean safety from investment loss. So the money won't go up and down based on the whims of the stock market. Just on the whims of, your own spending, I guess. And obviously a bank also cannot guarantee that it would pay you a certain interest rate for decades in the future either, but it will provide safety. So you need to go for your comfort zone, right? So if you're less tolerant of investment risk, or you're nearing retirement, you probably won't be chasing the 10% historical return of the overall market, but instead may be okay with 8 or 7% target growth instead. That's because the more risk you take, the more likely you are to miss that higher target growth, or lose money. And a higher target also means greater swings of your portfolio, okay? And if you want to know if there are ways to manage that risk, well, you'd never drive without buckling up, whether you're going 30 or 70, right? The same goes for investing. So I'll go over the core principles of managing investment risk in the next video in this playlist.